Bonds have exploded in popularity over the long run, as a long-term trend towards lower rates has made financing cheaper than ever for government and corporate borrowers alike. According to some estimates, the global bond market has more than tripled in size in the past 15 years and now exceeds $100 trillion. Dear viewers, stocks tend to get more media coverage than bonds, but the global bond market is actually larger by market capitalization than the equity market. In today's video, we're talking about what they exactly are and how you could invest in them in simple terms. As always, we have a bonus fact for you towards the end of the video, so don't forget to stay till the very end. With that being said, let's get into it. Number 1. What are bonds? Bonds are investment securities where an investor lends money to a company or a government for a set period of time in exchange for regular interest payments. Once the bond reaches maturity, the bond issuer returns the investor's money. Fixed income is a term often used to describe bonds, since your investment earns fixed payments over the life of the bond. Companies sell bonds to finance outgoing operations, new projects, or acquisitions. Governments sell bonds for funding purposes and also to supplement revenue from taxes. When you invest in a bond, you are a debt holder for the entity that is issuing the bond. Many types of bonds, especially investment-grade bonds, are lower-risk investments than equities, making them a key component to a well-rounded investment portfolio. Bonds can help hedge the risk of a more volatile investments like stocks, and they can provide a steady stream of income during your retirement years while preserving capital. Number 2. Key terms. Before we look at the different types of bonds and how they are priced and traded in the marketplace, it helps to understand key terms that apply to all bonds. Maturity. The date on which the bond issuers return the money lent to them by bond investors. Bonds have short, medium, and long maturities. Face value. Also known as par. Face value is the amount your bond will be worth at maturity. A bond's face value is also the basis for calculating interest payments due to bondholders. Most commonly, bonds have a par value of $1,000. Coupon. The fixed rate of interest that the bond issuer pays its bondholders. Using the $1,000 example, if a bond has a 3% coupon, the bond issuer promises to pay investors $30 per year until the bond's maturity date. 3% of $1,000 par value equals $30 per annum. Yield, the rate of return on the bond. While coupon is fixed, yield is variable and depends on a bond's price in the secondary market and other factors. Price. Many, if not most, bonds are traded after they've been issued. In the market, bonds have two prices, bid and ask. The bid price is the highest amount a buyer is willing to pay for a bond, while the ask price is the lowest price offered by a seller. Duration risk. This is a measure of how a bond's price might change as market interest rates fluctuate. Experts suggest that a bond will decrease 1% in price for every 1% increase in interest rates. The longer a bond's duration, the higher exposure its price has to changes in interest rates. Rating. Ratings agencies assign ratings to bonds and bond issuers based on their creditworthiness. Bond ratings help investors understand the risk of investing in bonds. Investment-grade bonds have rating of BBB or better. Number 3. Types of bonds. There are an almost endless variety of bond types. In the US, investment-grade bonds can be broadly classified into 4 types, which are corporate, government, agency, and municipal bonds depending on the entity that issues them. These 4 bond types also feature deferring tax treatments, which is a key consideration for bond investors. Corporate bonds. Corporate bonds are issued by public and private companies to fund day-to-day operations, expand production, fund research, or to finance acquisitions. Corporate bonds are subject to federal and state income taxes. Government bonds. U.S. government bonds are issued by the federal government. They are commonly known as treasuries because they are issued by the U.S. Treasury Department. Money raised from the sale of treasuries funds every aspect of government activity. They are subject to federal tax but exempt from state and local taxes. Agency bonds. Government-sponsored enterprises or GSEs like Fannie Mae and Freddie Mac issue agency bonds to provide funding for the federal mortgage, education, and agricultural lending programs. These bonds are subject to federal tax, but some are exempt from state and local taxes. Municipal bonds. States, cities, and countries issue municipal bonds to fund local projects. Interest earned on municipal bonds is tax-free at a federal level and often at the state level as well, making them an attractive investment for high net worth investors and those seeking tax-free income during retirement. Number 4. Bond features. We can further classify bonds according to the way they pay interest and certain other factors. Zero coupon bond. As their name suggests, zero coupon bonds do not make periodic interest payments. Instead, investors buy zero coupon bonds at a discount to their face value and are repaid the full face value at maturity. Callable bonds. These bonds let the issuer pay off the debt or call the bond before the maturity date. Call provisions are agreed to before the bond is issued. Puttable bonds. Investors have the option to redeem a puttable bond, also known as a put bond, earlier than the maturity date. Put bonds can offer single or several different dates for early redemption. Convertible bonds. These corporate bonds may be converted into shares of the issuing company's stock prior to maturity. Investors work with their financial advisors to help select bonds that provide income, tax advantages, and features that make the most sense for their financial goals. Number 5. Bond rating. All bonds carry risk of default. If a corporate or government bond issuers declares bankruptcy, that means they will likely default on their bond obligations, making it difficult for investors to get their principal back. Bond credit ratings help you understand the default risk involved with your bond investments. They also suggest the likelihood that the issuer will be able to reliably pay investors the bond's coupon rate. Generally speaking, the higher a bond's rating, the lower the coupon needs to be because of lower risk of default by the issuer. Number 6. Investing. You invest in bonds by buying new issues, purchasing bonds on the secondary market, or by buying bond mutual funds or exchange-traded funds. New bonds. You can buy bonds during their initial bond offering via many online brokerage accounts. Secondary market. Your brokerage account may offer the option to purchase bonds on the secondary market. Mutual funds. You can buy shares of bond funds. These mutual funds typically purchase a variety of bonds under the umbrella of a particular strategy. These include long-term bond funds or high-yield corporate bonds, among many other strategies. In a well-diversified investment portfolio, bonds can provide both stability and predictable income. And now it's time for the promised bonus fact. Thank you for staying with us, and now let's get into it. Bonds can be tax-free. Yes, you heard that right. There's an entire class of bonds aimed at providing tax-free returns. Cities and state issue municipal bonds, called Moonies for short, to raise money to pay for schools, highways, and a slew of other projects. Interest payments on the bonds are exempt from federal taxes. What do you think about investing in bonds? Let us know your thoughts down below. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time!